Imagine you're sitting in a cockpit, but instead of an altimeter and a fuel gauge.
Yeah, the dials are just spinning wildly.
Exactly. And they're spinning because of a rumor in New York or, I don't know, a policy shift in Beijing.
Or a cargo ship gets stuck in a canal. It all feeds in.
It does. It's 2026, and the South African financial markets, they aren't just a scoreboard for the local economy anymore.
Not at all. They've become this massive transmission mechanism.
A pipeline.
A pipeline, that's a good word. It takes all these global signals, mixes in the local noise, and then churns out prices and risks
And opportunities, if you're quick enough.
If you're sharp. It's really less about crunching numbers now and more about, reading a narrative.
One that changes by the minute.
And that narrative is moving faster than ever. Actually, before we really jump in, I want to flag something important for the professionals listening.
Ooh, right, the important bit.
The important bit. We know you're here for the analysis, but there's a practical benefit too. By completing the quiz that goes with this session, you can earn your CPD certificate.
So it's worth paying close attention.
It is. We aren't just chatting. We're ticking a box for your professional development.
A double win then. You get the insights and you get the credits.
That's the idea.
So let's lay out the mission for today. We're going to try and decode the actual toolkit that financial pros are using right now in 2026 to navigate the JSE and the wider economy.
We want to get inside their heads a bit.
See how they make sense of all this chaos.
But we should be really clear on one thing.
Do it.
This conversation is purely educational. We're breaking down analytical skills, frameworks, how to interpret things.
Right.
Nothing we say here is investment advice or a forecast for your portfolio. We're here to explain how the engine works, not tell you where to drive the car.
That's a very fair disclaimer.
Yeah.
Okay, let's set the scene. It's 2026. The world looks, let's call it textured.
Textured is a good word.
We've got this persistent currency volatility. Interest rate expectations are shifting constantly, and the global growth picture is patchy. It's uneven.
It feels like the rules of the game have tightened up. And for South Africa, being a small, open economy, we're essentially a cork bobbing in a very rough ocean.
So what happens here in our markets? It's a mirror.
A perfect mirror. It reflects domestic issues, load shedding, logistics, policy, but it also reflects global risk sentiment with, frankly, brutal efficiency.
So to understand why the JSE is moving today, you can't just look at Santon.
You have to be looking at Wall Street and Shanghai.
Okay, so let's look at that dashboard. The biggest, loudest flashing dial has to be the rand. It feels like it's become the world's favorite anxiety barometer. Why is it so twitchy?
It's because it's one of the most liquid emerging market currencies in the world, so it becomes a proxy for global risk.
A proxy? What do you mean?
Well, when a fund manager in London or New York gets nervous about anything, it could be U.S. monetary policy, geopolitical tension, whatever, they don't sell their illiquid assets first.
They sell what's easy to sell.
Sell what they can sell quickly. And often, that's the rand.
So we kind of take the hit for everyone else's stress.
In a way, yeah. It comes down to capital flows.
Yeah.
When the global mood is risk on, investors are feeling brave.
Looking for yield.
Exactly, looking for yield. We see these big portfolio inflows. They buy our bonds, they buy our equities, and all that demand supports the currency.
But the moment that mood flips,
the second it flips to risk off, that capital reverses. It just flows out to perceived safety. And because we're so open to those flows, the rand swings violently.
Which explains why you can have a day where South African news is completely quiet, but the currency drops 2%.
It's rarely just about us in isolation. It's about our place in the global queue for capital.
Okay, so the second dial then, interest rates and inflation. We all know the Reserve Bank pulls the lever on the repo rate, but analysts seem obsessed with bond yields as some kind of crystal ball. What are they seeing in that yield curve?
The yield curve is probably the most honest indicator in finance.
Why is that?
Because it tells you what the market really thinks, not just what a central banker is saying in a press conference. You look at the shape of it.
Right.
If it's steepening, so the yield on a 10-year bond is way higher than a 2-year bond, the market is demanding a bigger premium for long-term risk.
They're basically saying, I'll lend you money for 10 years, but I'm worried about inflation eating away my return.
That, or they're worried about the government's fiscal discipline. A steepening curve often signals fear of future inflation or a deteriorating credit profile.
And what if it flattens or inverts?
If it flattens, or worse, inverts, where short-term rates are actually higher than long-term ones, The market is screaming that a slowdown or a recession is coming. It's expecting rates to be cut eventually.
So rising yields could be an inflation warning, but falling yields could be a growth warning. It's tricky.
It creates a really tough dynamic for stocks, too. I mean, if the risk-free rate on a government bond goes up to, say, 12%.
Suddenly that stock paying a 5% dividend doesn't look so hot.
Exactly. Capital shifts.
Which brings us to the third big macro driver, the commodity cycle. You can't talk about this economy without talking about gold, PGMs, energy.
No, it's the classic double-edged sword of a resource economy.
How so?
When commodity prices are high, it's a party. Export earnings surge, mining companies pay massive dividends, and the Treasury gets this tax windfall that makes the budget look fantastic.
It papers over a lot of cracks.
It masks a lot of structural weaknesses, yes.
But when that cycle turns,
the hangover is immediate, prices drop, that tax revenue just evaporates, and the rand usually takes a beating because our terms of trade have worsened.
And in 2026?
In 2026, analysts are watching China's industrial demand like hawks. That really sets the price floor for most of our resources. If that demand softens, the whole dashboard flashes red.
Okay, so that's the macro picture, but markets are made of people, or I guess algorithms programmed by people.
Right.
So let's talk about market behavior. There's this concept of the surprise factor. Why does the market freak out over a decimal point in an inflation print?
Because markets are giant expectation machines. Everything that is known is already priced in.
It's in the price.
It's in the price. So if we all expect inflation to be 5% and it comes in at 5%, the market barely moves. It's a non-event. But if it comes in at 5.2%, chaos. Because everyone has to rewrite their homework at the same time.
They have to reprice risk.
That's it. If the data deviates from the consensus, every model needs to be updated. That violent repricing is volatility. It's not just random ups and downs. It's the market scrambling to find a new equilibrium.
And this ties into the idea of liquidity, right? I keep hearing that in 2026, liquidity is the only thing that matters.
Liquidity is like oxygen. You don't notice it until it's gone.
That's a great way to put it.
In a normal market, you can sell a stock and find a buyer instantly, close to the last traded price. In a stressed, low liquidity market, you might want to sell, but the buyers have all vanished.
So to get out, you have to drop your price.
By 5%, maybe 10%, and that's how a paper loss turns into a realized disaster. And in emerging markets, liquidity can just evaporate during a risk-off event.
Let's dig back into that risk-on versus risk-off switch. It sounds so binary, like a light switch. Is it really that simple?
Well, it feels binary because of how correlated all the assets become.
What do you mean?
In a risk-on world, capital floods into the JSE, hunting for growth. You see retailers, banks, industrials all rallying. But when that switch flips to risk-off, investors don't just sell the risky stuff.
They run for safety.
They run for safety. Usually U.S. Treasuries, maybe gold.
And on the JSE, does everything get hit equally in that scenario?
No. And this is where the pros make their money. It's all about sector sensitivity.
Okay.
So let's take a weak rand scenario. The knee-jerk reaction is South Africa is in trouble, sell everything. But a smart analyst looks at the resource counters.
The miners.
The miners, right. A gold miner pays its wages and electricity in rand, but it sells its gold in dollars.
Ah, I see.
So if the rand crashes, their costs stay relatively flat, but their revenue, when converted back to rand, it just skyrockets. A currency crash can actually trigger an earnings boom for them.
Right. But at the same time, the retailer who's importing televisions
is in a nightmare scenario. Their costs explode because they have to pay in dollars. They try to pass that on to the consumer, but the consumer is already squeezed, so their margins just collapse.
So the same macro event,
Yeah.
a weak rand, creates a winner and a loser on the exact same stock exchange.
And that's the job. You can't just buy the market. You have to pick your exposure based on the narrative.
Okay, let's open the toolbox then. The analyst's toolkit. We have equities, obviously, but there's this big distinction people make between fundamentals and sentiment. And I feel like in the short term, sentiment wins every time.
There's an old saying, in the short term, the market is a voting machine. In the long term, it's a weighing machine.
I like that.
Fundamentals are the gravity earnings, cash flow, debt, but sentiment is the wind. A company can have pristine fundamentals, but if the market sentiment is emerging markets are uninvestable right now, that stock is going down.
So the analyst's job is to spot that divergence, to say this company is good, but the market hates it right now.
That's where you find opportunity. You're looking for a broken stock price, not a broken company.
What about fixed income? We mentioned government bonds, but corporate bonds seem to be getting more attention these days.
Corporate paper offers what we call a yield pickup. You get a higher interest rate than on a government bond.
But there's a catch.
But you're taking on credit risk. The risk that that specific company might go bust. Analysts spend days poring over balance sheets just to assess if that extra 2% yield is worth the risk of a default.
Okay, now for the one that scares people, derivatives. Futures, options, swaps.
The Hollywood stuff.
Yeah, the movies make it look like pure gambling. But in a professional toolkit, these are more like safety belts, aren't they?
We really need to reframe derivatives. They're what-if tools. Think about a farmer.
Okay.
He doesn't know what the price of corn will be at harvest time, so he sells a future. He locks in a price today to guarantee he can survive. He's not gambling, he's de-risking.
And for a bank or a big fund manager,
It's the same logic. An interest rate swap is huge in 2026. If a company has a massive loan with a variable interest rate and their terrified rates will spike,
which is a real fear.
a very real fear, they can use a swap to trade that variable rate for a fixed one. They pay a small premium for certainty. It's a management tool.
And options.
Options are all about asymmetric risk. They let you model scenarios. You might think, I believe the stock might crash, but I'm not sure.
So you buy a put option.
Exactly. If the stock crashes, the option pays out and it offsets the loss in your portfolio. If the stock doesn't crash, all you lose is the small cost of the option. It's just insurance.
Then there's FX foreign exchange. It's not just the spot price on the screen, is it? There's the forward rate, too.
The forward rate is fascinating. It tells you where the market thinks money is flowing. The gap between the spot price now and the forward price in the future is mostly determined by the interest rate difference between two countries.
So it's a mathematical way to see how expensive it is to bet against the rand.
In a sense, yes.
And finally, the toolkit has expanded to include alternative assets. ESG-linked instruments seem to be everywhere now.
It's not a trend anymore. It's the actual structure of the market. We're seeing green bonds, where the money is legally ring-fenced for renewable energy or water projects.
But it's more than that, right?
Much more. We're seeing the actual cost of capital change.
You mean it's literally cheaper to be green?
It is starting to be, yes. If you have strong ESG, environmental, social governance credentials, you can access pools of capital that are completely off limits to dirty industries.
And the reverse is true.
The reverse is true. If you're a coal miner with a poor safety record, your pool of potential investors is shrinking, which means you have to pay a much higher interest rate to attract any money at all. ESG is pricing directly into risk.
Values are becoming valued.
That's a perfect way to put it.
This leads us to the final piece, professional skills. Because you can have all the data and the fancy tools, but if you don't have good judgment, you're dead in the water.
Interpretation versus observation. That is the core skill. An algorithm can observe. It can tell you gold is down. A human analyst has to interpret.
To find the why.
They find the why. Gold is down because real interest rates in the US rose, which means this isn't a gold-specific problem, it's a macro shift. Context is everything. It determines if you ignore the noise or trade the signal.
I love this idea of scenario planning, the concept of stress testing a portfolio. It sounds like you're actively trying to break your own investments.
You have to. You can't predict the future, so you have to prepare for the worst versions of it. You ask the hard questions.
Like what?
Like, what happens to this portfolio if the rand blows out to 25 to the $AUD interest rates spike by 200 basis points at the same time?
That sounds like a financial horror movie.
It is. But you run the numbers, and maybe you find out that, okay, your banking stocks collapse, but your offshore tech stocks and your gold miners rally enough to keep you afloat.
And if the stress test shows you go bankrupt?
You change the portfolio today. You don't wait for the crisis to hit. It's proactive defense.
And then you have to explain that to a client.
Which is the communication skill. And, financial pros are notorious for jargon.
They are.
But the best analysts in 2026 are the best storytellers. You have to explain why the portfolio is down without hiding behind complex terms. Transparency builds trust. You aren't giving advice, you're providing clarity.
And the last skill, critical thinking. This feels like it's about questioning the old rules.
Absolutely. Correlations change. Just because the rand and the platinum price move together for 10 years doesn't mean they will tomorrow. The world changes. A good analyst is always skeptical. They're always asking, is this relationship still valid?
So we bring this all together. A synthesis. The dashboard is flashing, the tools are complex. What's the one thing you want a listener to take away from all this?
I think it's about interconnectedness. You just cannot look at the JSE in a vacuum anymore. You can't analyze a South African bank without understanding U.S. inflation, Chinese growth, and local politics all at the same time.
It's all one giant web.
It's one giant throbbing web of cause and effect. And financial literacy today is about understanding how that web works.
And looking forward, I mean, technology must be helping, right?
Yeah.
AI, big data.
Oh, it's speeding everything up. We have better data faster than ever. But that just commoditizes the what, the so what, the judgment, the ethical consideration, the gut check. That's still human.
That's a comforting thought.
Yeah.
You mentioned the ethical side there.
I did, and I want to leave listeners with a provocation on that. We talked about ESG. I think we are moving toward a world where sustainable finance isn't a separate category.
It just becomes finance.
It's just finance. And if capital permanently avoids unethical or unsustainable assets, we are going to see a fundamental repricing of the entire global economy based on values. And that is a massive shift to prepare for.
So it's not just about the bottom line anymore. It's about how you got there.
And whether you can keep getting there in the future.
Well, that feels like a really good place to end today's analysis. We've gone from the twitchy rand to the yield curve crystal ball and the stress tests that keep us honest. It's a complex machine, but hopefully the dials make a little more sense now.
Just remember to keep watching that dashboard. And for those collecting their credits, don't forget to head over and complete the quiz associated with this session. That's your final step to getting the certificate.
Absolutely. Get that quiz done, claim your credits, keep analyzing, keep questioning the narrative, and we will catch you next time.